Picture this. You're standing at the edge of a cliff, $100,000 in hand. Below you, the market churns like a stormy sea. Every financial headline screams, "Crash coming." Every expert points to different warning signs. Inflation persists, unemployment ticks up, the Fed seems uncertain, and now, with new tariffs looming on the horizon, that sea looks even more treacherous. So what do? Jump in all at once? Wade in slowly? Or wait on the sidelines until the storm passes? If you're feeling this anxiety right now, you're not alone. I've been getting messages from viewers just like you every single day. I've been saving for years and finally have $50,000 to invest, but the market drops every time I buy. Should I just wait? I put in $10,000 last month and I'm already down 8%. Did I make a huge mistake? Here's the truth. Most investors are getting this completely wrong in 2025. They're either frozen in fear, watching opportunities slip by, or they're using outdated strategies that might actually be costing them thousands in future wealth. But today, I'm going to show you something different. A hybrid approach that's specifically calibrated for this unique market environment we're facing. It's not just theory. It's backed by decades of market data, including studies that most financial advisors never share with their clients. This isn't about timing the market perfectly. It's about creating a system that works whether the market crashes tomorrow or climbs for the next 6 months. A strategy that gives you the best of both worlds. By the end of this video, you'll have a clear, actionable plan for that $100,000, or whatever amount you're looking to invest. A plan that helps you sleep at night while still positioning you to potentially capture the enormous wealth-building opportunities that market corrections create. The Investment Dilemma Explained. Let's tackle the question that's keeping thousands of investors up at night right now. I have $100,000 to invest today. What should I do with it? It seems simple enough, but in 2025's market environment, this decision carries more weight than ever before. We're experiencing a perfect storm of market pressures. The 2024 election aftermath has created policy uncertainty. Tech stocks that led the market for years are showing cracks. The geopolitical landscape is shifting weekly. And with those new tariffs announced for next month, we're seeing supply chains brace for impact once again. All of this creates a very real dilemma for you, the investor. On one hand, historical data tells us that time in the market beats timing the market. The longer your money is invested, the more opportunity it has to compound and grow. On the other hand, nobody wants to invest their hard-earned money only to watch it immediately drop 10, 15, or even 20% in value. That psychological pain is real. I've felt it myself, and I've seen it break the resolve of even experienced investors. This is why I'm getting dozens of messages daily from viewers facing this exact challenge. The stakes feel higher than ever. Should I put everything in at once and potentially benefit from any upside? Should I gradually invest over time to protect myself from a major drop? Or should I wait for the big crash everyone's talking about? What makes this particularly challenging in 2025 is that we're not in a clear bear or bull market. We're in this volatile sideways churn, where good news can send markets soaring one day, and similar news can trigger a sell-off the next. But here's what you need to understand before we dive into the solution. This dilemma isn't actually about predicting the market. It's about creating a strategic framework that works regardless of what happens next. So let's break down the two classic approaches investors typically consider, and then I'll show you how to combine their strengths while eliminating their weaknesses. Understanding the classic strategies. When it comes to investing a significant sum in today's volatile market, there are two primary strategies most investors consider. First, there's dollar cost averaging, or DCA. This approach is beautifully simple. You take your total investment amount and divide it into equal portions that you invest at regular intervals, regardless of market conditions. For example, with $100,000, you might invest $10,000 each month for 10 consecutive months. The magic of DCA lies in its psychological comfort and mathematical balance. When prices drop, your fixed amount buys more shares. When prices rise, you purchase fewer shares, but benefit from the appreciation of your earlier investments. It removes the emotional guesswork and prevents you from trying to time the perfect entry point. The alternative approach is what we call buy the dip. This strategy keeps your powder dry, holding your capital in cash while you wait for significant market pullbacks before deploying your funds. The theory is appealing. Why buy at higher prices when you could potentially buy the same assets at a discount later? Proponents of buying the dip point to major market corrections as golden opportunities. Imagine purchasing stocks after a 15% market decline. You're essentially getting everything on sale. When the market eventually recovers, those discounted purchases could generate substantially higher returns than if you had bought at peak prices. Both strategies have passionate advocates, and on the surface, each makes logical sense. Dollar cost averaging offers consistency, emotional stability, and the certainty that you're always participating in the market's long-term upward trajectory. Buy the dip promises the excitement of strategic timing and the potential for enhanced returns by capitalizing on market inefficiencies and fear. The question isn't which strategy sounds better in theory. It's which strategy actually delivers superior results in real-world conditions, particularly in the unique market environment we're facing in 2025. And that's where the data comes in. Data that might completely change how you view these classic approaches and lead you to a more nuanced understanding of how to deploy your investment capital right now. What the data actually shows. Let's cut through the noise and look at what the research actually tells us about these strategies. Nick Maguli conducted a fascinating study comparing dollar cost averaging against buy the dip, and the results might surprise you. For the buy the dip strategy, he assumed something practically impossible: an investor who could perfectly identify the absolute bottom between any two all-time market highs. Even with this enormous advantage, DCA still outperformed buy the dip more than 70% of the time over long periods. Think about that. Even if you had a superpower to identify perfect dip buying opportunities, you'd still underperform a simple, consistent investment strategy most of the time. Between 1995 and 2018, buy the dip did manage to edge out DCA, but the margin was razor thin. This period included the significant crashes of 2003 and 2009, which gave dip buyers rare opportunities. But extend the timeline, look at any 40-year period in market history, and the advantage completely disappears. Dollar cost averaging consistently beats perfect dip timing more than 70% of the time. From 1975 to 2014, DCA clearly outperformed buy the dip strategies. The reason is both simple and profound. While you're waiting for that perfect dip, the market is typically climbing higher, leaving you behind with cash earning minimal returns. Perhaps even more eye-opening is what JP Morgan's 2019 retirement guide revealed. From 1999 to 2018, if you missed just the 10 best days in the market, your overall return was cut in half. Miss the top 20 best days, and your returns actually turn negative. The cruel irony? Many of the market's best days occur shortly after its worst days, precisely when nervous dip buyers might still be waiting for further declines before jumping in. The data exposes a harsh truth. Market timing isn't just difficult, it's nearly impossible to execute effectively. The most devastating blow to the buy the dip theory comes when we introduce reality into the equation. When researchers modeled a more realistic scenario, where investors missed the exact bottom by just 2 months, DCA outperformed buy the dip a staggering 97% of the time. Not 70%, to 97%. This isn't just an academic distinction. It's the difference between building significant wealth and potentially undermining your entire financial future. Every piece of serious academic research points to the same conclusion. Consistent investing beats tactical timing for the vast majority of investors in the vast majority of market conditions. But here's where things get interesting for us in 2025's unique market environment. The 2025 hybrid strategy revealed. Now I'm going to share something that most financial advisors won't tell you. There's a middle path that incorporates the mathematical advantage of DCA with the opportunistic potential of buying significant dips. This isn't theory. It's a concrete strategy I've developed specifically for the 2025 market conditions we're facing right now. Here's the approach. Take your investment capital. Let's use that $100,000 example and divide it by 10 months. This brings us to early 2026, by which time many of the current uncertainties plaguing the market will likely have resolved. The new administration will have established clear policy directions. The Fed's interest rate path will be more defined. Corporate earnings will have adjusted to the new economic reality. We'll have clarity, even if the path remains challenging. So you start by investing $10,000 each month, regardless of market conditions. This gives you the psychological comfort of DCA and ensures you're not sitting completely on the sidelines. But here's the twist. You remain vigilant for what I call a trigger event. If at any point during those 10 months the S&P 500 drops by 15% or more in a single week, that's your signal to deploy a significant portion of your remaining capital immediately. Let's say we're in July, 3 or 4 months into this plan. You've already invested $40,000 through your monthly contributions. Suddenly, the market tanks hard, maybe due to unexpected inflation data, geopolitical tensions, or a black swan event. The S&P 500 plummets 15% in a week. At this point, you're no longer in a garden variety correction. You're witnessing a genuine market panic. This is when you take approximately 70% of your remaining funds, about $60,000, and invest it all at once. Why does this work? Because we're not trying to time the absolute bottom. We're simply identifying a threshold where historical data suggests the risk-reward ratio has shifted dramatically in our favor. Even if the market falls further after your lump sum investment, you've still secured a much better average price than if you'd invested everything at the beginning. And if the market rebounds quickly, you've positioned a significant portion of your capital to ride that recovery from a favorable entry point. This hybrid approach gives you the best of both worlds, the disciplined regularity of DCA combined with the opportunistic firepower to capitalize on significant market dislocations. It keeps you in the game while maintaining the flexibility to seize rare opportunities. It's mathematically sound and psychologically manageable. Exactly what investors need in 2025's challenging environment. Safety-proofing your approach. While this hybrid strategy positions you for success in 2025's volatile market, we need to establish a critical safety framework around it. Remember, even the best investment strategy fails if you're forced to sell at the worst possible time. So here's how to ensure you're truly prepared. First, maintain a robust emergency fund separate from your investment capital. In this economic environment, aim for 6 to 9 months of essential expenses and high-yield savings. This gives you breathing room if the job market weakens alongside the stock market decline. Never invest money you might need within the next 3 to 5 years. Market recoveries can take time, and you don't want to be forced to sell at a loss. Next, assess your debt situation before implementing this strategy. High-interest debt effectively creates a negative return that's guaranteed, unlike the potential market gains we're pursuing. If you're carrying credit card balances at 20% plus interest, focus on eliminating those first. Even with moderate interest debt like auto loans, consider your total financial picture before fully committing to this investment approach. Your investment strategy should always align with your complete financial reality. Perhaps most important is preparing yourself psychologically. Even knowing the logic behind this hybrid approach, watching your investments temporarily decline can trigger powerful emotional responses. Commit now to following your plan regardless of market headlines or short-term volatility. Write down your strategy and review it whenever anxiety rises. Remember that historically, those who maintain discipline through market turbulence are ultimately rewarded for their patience and perseverance. If you found this strategy valuable, make sure to like and subscribe for ongoing updates as this market situation evolves. I'll be providing regular analysis of potential trigger events and how to adapt this approach as economic conditions change. Drop a comment with any questions about implementing this strategy with your specific financial situation. Remember, while the market may be unpredictable, your approach to it doesn't have to be. With the right strategy and proper preparation, you can navigate even the most challenging market environments with confidence and clarity.